as always. Thank you, Alicia Levine of BNY Wealth there. Equity futures on the S&P down by 0.25% with an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. Boeing reported its first quarter with CEO Kelly Ortberg at the helm. In it, Ortberg warned that Boeing will need to overhaul its culture to end its multi-year crisis. He laid out a four-pronged plan to move forward, saying it will, quote, take time to return Boeing to its former legacy. As for the earnings themselves, Boeing reported a negative free cash flow of $2 billion in the quarter. JP Morgan is in talks to start trading physical LNG after more than a decade on the sidelines. People familiar told us that the bank has held talks to secure a long-term LNG supply, and at least 3 projects are under development in the Gulf Coast. JPM has been pushing in recent years to get back into trading some of those physical commodities that it abandoned in 2014. Security State Anthony Blinken has arrived in Saudi Arabia after meeting with Israeli Prime Minister Benjamin Netanyahu and President Isaac Herzog in Israel. Blinken said both agreed that the killing of Hamas leader Yahya Sinwar has opened new possibilities for ending the war in Gaza, but made no indication on a plan for what comes next. This is Blinken's 11th trip to the Middle East since last year's attacks on October 7th, and likely his last before the presidential election. And that's your brief. John.
Danny, thank you. More from Danny in about 30 minutes. Up next on the program, the Morning Calls Plus, Republican Senator Tom Tillis of North Carolina. That conversation just around the corner. From New York, good morning. Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
This is Bloomberg Technology.
This is the Asia Trade.
You're watching the close.
Welcome to Balance of Power.
This is Bloomberg.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bloomberg covers the world with unmatched reach and resources. From more than 120 countries, the moment news breaks, 24 hours a day. Bloomberg. Context changes everything.
The opening bow 1 hour and 14 minutes away. Equity futures on the S&P 500 negative here by 0.25%. Treasuries softer, lower down for a third consecutive session. Yields a little bit higher. We're up by almost 3 basis points. Your 10-year 4.2336. Time now for some morning calls. First up, Baird downgrading McDonald's to neutral, saying reports of an E. coli outbreak could impact consumer sentiment. You think? We're down by 7% in the pre-market. Your second call from Stifel, cutting its price target on Starbucks to 105, pointing to weaker than expected top-line results. We're down there by 3.3. And finally, JMP Securities upgrading Snap to outperform. The analyst expecting a strong earnings report next week. The stock is up by 2.5%. Let's turn to the election. More than 1 million people have cast early votes in the key swing state of North Carolina as communities there continue to grapple with the aftermath of Hurricane Helene. Polling averages in the state showing Trump holding a lead under half a percentage point. I'm pleased to say that joining us now is the North Carolina Senator, Tom Tillis. Senator Tillis, it's good to see you, sir. Thanks for being here. Let's start with your community, and good morning to you. What a difficult moment for North Carolina. Can you just walk us through the devastation that you've witnessed over the last month?
Yeah, I think it's important for everyone to understand. We've seen the images of Asheville, and it's a profound problem there, but it's an impact zone roughly the size of the state of Massachusetts. So what you've seen in Asheville, I can take you to a dozen other places where people are suffering, communities cut off. No drinkable water in Asheville yet, and it may take a few more weeks before they can start boiling water. So it's a crisis that we've never seen in the mountains. We have never in this country seen a hurricane impact in the mountains. It basically maintained the integrity of a hurricane, went up into North Carolina, dumped 30 inches of water on several river basins simultaneously. And so we've got a long haul. We've got a 20-mile segment of I-40 that's going to be shut down for a year or two. $1 billion for that one piece of infrastructure, 80 miles of railroad bed, hundreds of bridges and roads. So we've got a lot of work cut out for us, and one of the things we're going to have to do is recognize that this recovery is very different from any other storm. It's going to take longer. We're going to have exceptions that generally only last for a year or two, for probably 4 or 5 years to get rebuilt.
Are you getting everything you deserve and you need from the federal government?
I think at this point we're doing okay. I had some differences with the governor about surging DOD resources from Fort Bragg, Fort Liberty, and the 101st Airborne. A little slow to respond, but I think that they're doing a good job. And the relief effort on the ground, FEMA resources, American Red Cross, Samaritan's Purse, all of those folks are doing extraordinary work, as they always do in a storm impact.
The vast majorities of the counties that were hit voted Republican in 2020. What is it looking like now, getting these individuals to the polls?
Well, actually, they're doing an extraordinary job. Yancey County, which was one of the hardest hit areas, had amazing turnout. And one of the things we're working with here is we're doing early voting very differently. Normally, North Carolina is one of the first states to vote, and that's in September for early voting, where we got delayed for a variety of reasons, one of which was updating the ballot. But they're coming out. We've just got to make sure that they have that opportunity. The legislature has passed laws 2 weeks ago that allow them to vote in various locations, so they're not as stringent if you're in a disaster-declared county. So we're doing everything to make sure that every vote counts.
So do you think the hurricane is going to have an impact on potentially Donald Trump being able to maintain his hold on North Carolina being a red state?
No, I don't think so. I think President Trump wins by a margin of about what he won in 2020. I was up for election in the same year. I think that President Trump carries the state.
Meanwhile, you've been vocal about how you see things back in D.C., especially as we head to November, sort of hard pivot. I apologize, but I am curious to get your take on it, because not only in November are we going to get a presidential election, but we're also going to get Senate Minority Leader Mitch McConnell stepping down. Are you in the running? Are you going to be the Senate?
I'm going to vote for a guy named John, and with all due respect. But I'm going to vote.
We need a last name to understand what you're talking about.
Yeah, thanks.
I don't think they want us to be Pharaoh.
Yeah.
But carry on, please.
They're both solid leaders. They're both good friends of mine, and I think they'll do a good job of leading the conference. We're going to have that vote in a couple of weeks.
There's been a lot of pushback saying we need new leadership. We need a different brand of leadership. That's sort of the old guard of Republican rule or governance in Washington, D.C. And it seems like the Donald Trump camp has been at loggerheads in the past with that particular leadership group. Do you think that his coming back to the presidential office would challenge either of those Johns, John Thune or John Cornyn, if people were wondering?
I forgot. I don't think so. The Senate is a weird thing to understand unless you're a part of it. We like to be led by people who have an election certificate who are senators. So we tend to elect our leaders from within. We don't like outside influences. The arguments that were set forth by one of my colleagues, Mike Lee, are arguments that we have to distinguish between the Senate rules and the conference rules. What Mike or Senator Lee is talking about doing is the conference rules, which would unilaterally weaken our leader as they match up to the Democrat leader. If we want to have a discussion about changing some of the Senate rules, count me in. I've got a long list, but that's going to require bipartisan agreement to make the Senate more efficient. It makes no sense to unilaterally disarm against a very powerful leader model in the Democrat conference.
Or do you think then that either of these senators, named John, are just basically going to be a continuation of Mitch McConnell and his style and his leadership?
No, I don't think so. I think the other thing that's funny about Mitch McConnell, incidentally, I have a dog named Mitch. I'm a big fan of Mitch McConnell.
Was it actually named after Mitch?
It was named after Mitch. He's about 4 years old, and he's an extraordinary dog. Mitch is an extraordinary leader. But people get it wrong. You don't go into the office and get assigned a legislative initiative by Mitch McConnell. You go get a good idea, sell the leadership on it, and run with it. And so I would just argue for people who think that that's how it works to open their eyes and realize if you step up and you lead and you have something that you can build support for in the conference, you're going to be able to move it. That's just the way that Mitch operates.
You're talking about the way that Senate operates, and that is traditionally, and we're dealing with an election right now where there have been some questions about whether some of those rules would be questioned or undermined, not necessarily with the Senate, but certainly with federal employees, and what we've heard some of the proposals from former President Donald Trump. And I'm just wondering whether you think that his style clashes with the style that you are talking about and that you've been a part of.
No, actually, the President Trump style is what we need. I was a management consultant. I was a partner at Pricewaterhouse, did organization transformation. You need people that stretch, right? And President Trump set stretch goals. But you need that kind of friction between the two branches of government, I think, to really get moving more quickly, to get things done, not just to continue to promise every 4 years that this is the 4 years it's going to get done. So as long as we've got to exercise patience with the executive branch has to exercise patience with us, because we need to get legislation out the door that has enduring quality. And the only way you do that is through bipartisan results. We are clearly, if we run the table, going to use reconciliation, simple majorities, no Democrat votes, to extend the tax provisions from 2017, et cetera. But we should never take our eye off the ball of working with Democrats, as I have multiple times, on significant legislation to actually do the hard work in the Senate.
Well, you're from a purple state. You're governor right now. I interviewed a few weeks ago, Roy Cooper. You have to work with him a lot. But I want to ask you about leading North Carolina. What do you make of your Republican candidate for the governorship?
Well, Mr. Robinson and I have a disagreement. Mine was more rooted in I think, the credentials for the job. We are the 9th most populous state, and we're one of the most popular states to move to for business. We have to have proven executive leadership there. I served with Josh Stein. I believe he is a pro-tax, pro-regulation liberal, and I wish we were matching up a candidate that could actually defeat him. I just don't think that Mr. Robinson's going to get it done.
Final question. Madison Square Garden, Donald Trump campaign. You attending?
I am not going to.
Just wondering if that's why you're in town.
I will be back in North Carolina.
Senator, appreciate your time and good luck with the rebuild. Thinking of you all. Thank you, sir. Senator Tom Tillis there of North Carolina. Coming up next on this program, we'll catch up with Francis Donald of RBC and Troy Gajewski of FS Investments. Your equity market shaping up as follows this morning. On the S&P, we're a bit softer near session lows. We're down 0.2%. Bond yields drifting higher once again, up by 3 basis points on a 10-year right now, 4.23, call it 4.24 almost. And in foreign exchange, stands out for me this morning, session highs. Dollar yen takes out 153. Takes out 153, and bear in mind, the low of the year was 2 days before the Federal Reserve cut interest rates on September 16th. That was the low at 140. That's a monster turnaround in dollar yen. 153, we're up by 1.3%. From New York City, this is Bloomberg.
countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Welcome to the world of decentralized finance.
With a surge in Bitcoin, you have crypto stocks also surging.
Bloomberg's covering all things crypto, the people.
This is a political attack, and we must hold our elected officials accountable.
The transactions.
Really a record-breaking moment.
Bitcoin is the exit strategy.
And the technology.
Awareness is going to grow, and these things grow the overall industry.
Crypto as an asset class is here to stay.
Bloomberg Crypto, only on Bloomberg.
One hour away from the opening bell. Equity futures just off session lows. We're down just a touch once again. We're negative by 0.25%. With 60 minutes until the cash open, let's get you some morning movers and cross over to Manus Cranny. Good morning, Manus.
Jonathan, a very good morning to you. McDonald's is off its low point of the day. It's grappling with the E. coli breakout, where you have dozens of illnesses and one death. The question here is about containment, control, and convincing the investor out there that they have got a handle on this. JP Morgan say the stock is now trading on emotion and worry, and that this E. coli breakout is not going to engulf the United States of America nor go international. You want to buy the sell-off, according to JPM. Morgan Stanley say it's a knee-jerk reaction. There are two big houses on the street, however, that caution and downgrade their price targets. Baird goes to 290 on a downgrade, and you've got Guggenheim cautious on this stock at 285. So again, it depends on whether you believe containment and control has been delivered. Revenge tourism, it was a narrative of 22, 23, and is it fading in 2024? Hilton lowers their profit outlook. Is revenge tourism fading? That's the question that goes through my mind. You look at the RevPAR here in the United States of America, revenue per available room, it grows by 1%. In Europe, it's up nearly 7%, but here there is just a little bit of a leveling off. You've got strikes, of course, that they've worked their way through, and you have Hurricane Helene. This is as they add 33,000 new rooms. It's a record for Hilton, expanding into a slowdown. Let me take you to Qualcomm. This is a kind of nuclear option that ARM has gone for. They scrapped the design license with Qualcomm. 60 days and counting to get a deal on this dispute. It impacts both of them. So it looks like ARM's gone for the nuclear option. JP Morgan say that they will probably negotiate a deal. But some context for you. Qualcomm sell about 100 million processors into phones, Android phones, along with PCs. And do not underestimate, Qualcomm is 11% of ARM's revenue. This is a battle that will brew for 60 days. Jonathan, good morning.
Manus Cranny, good morning to you, sir. Appreciate it. I haven't heard that phrase for a long time. Revenge tourism, revenge spend. I remember Chris Harvey of Wells Fargo came out just after the pandemic, lockdown's over, and he said, John, it's going to be spring break for adults for the next 2 years. And that's what it was.
It was, and then it was get back to the office, spring break is over.
Yeah.
We've seen that increasingly. What did you say earlier, that you invest in the US and you travel and you tour in Europe?
It's not my line. I've heard this a few times. Yeah.
So that's essentially what he explained.
Europe's good for vacations,
yeah, exactly.
but not for investing.
Thank you. Yeah, that's good.
Yeah, that's the line.
Thanks.
Not my line. I'm not going to name the guy who said it, because I found it offensive at the time. I was upset with him. Investors are waiting fresh economic data this week, looking for further signs of economic strength. Francis Donald of RBC writing, forget soft landing versus hard landing. The US is in a K-shaped economy. Certain segments of the US economy are doing exceptionally well, but others are empirically recessionary. Francis joins us now and got a round of applause when she walked into the studio. Congratulations on the new seat. It's good to see you.
Thank you. It's very exciting.
It's good to catch up with you. Let's talk about this economy. How do you set policy for that economy?
Oh, Well, you have to set policy for the aggregate, and that's why when you have folks coming on this show, they're talking about the whole size of the pie. And when you look at the economy as a whole, it is in what they would call a soft landing. It is going to be really difficult in 2025 to get 2 quarters of negative GDP. And yet, if you're doing anything else in this economy, if you're a small business owner, if you're picking stocks, you have to go beyond that GDP number. You have to look under the surface. And when you do that, what you will find is that it is not just a dual mandate for the Federal Reserve, it is a dual economy. We have pockets of extraordinary strength and resilience, big companies, high-income consumers, and then we have pockets of real weakness, small businesses, low income. So when folks say, you know, there are recessionary signals, they are right. When they say the economy is resilient, they are also right. I'm like a mom at a football game. Everybody wins. Everybody is correct in this environment. It depends what your target is going to be.
Well, let's work with the aggregate for the focus for the purpose of policy. In August, we'd just come off the July jobs report. Not great. Chairman Powell goes to Jackson Hole, delivers a really dovish speech, and the conversation changes really quickly. There are major concerns about cracks in the labor market, and maybe this horrible cycle where this unemployment rate just feeds on itself and we start to approach 5 pretty quickly. 2 months later, we've got guests debating whether this economy is reaccelerating.
What you're speaking to is extraordinary amounts of uncertainty. And I know we talk about all the time, but there is a extraordinary uncertainty tax on this economy. It is coming from the election. Huge amounts of surveys are telling us, businesses are saying we can't make decisions until we know the outcome. So there's a pause occurring on it. Revisions in the data. How often are we talking about massive revisions that change the story? Who knows? Maybe we could get a big revision over last month's data. And then, of course, we have very low response rates. So our ability to navigate month to month is certainly declining. That's why we have to focus on some of these longer 6 to 12 month themes. My sense is that the Federal Reserve is going to have to do this too, because they're aware of how limited their visibility is as well. What they should be looking at is that the unemployment rate has been steadily rising since January of 2023. The trend is going in that direction. They're going to be focusing on massive amounts of deficit and debt at the federal level, how that offsets or the risks that there has to be a pullback sometime in the next few years, and they're going to be focused on normalizing those rates to bring them back in line with where the general sense of the economy is. I hope this Federal Reserve is not going month to month off of the data when we're seeing this level of revisions, uncertainty, and low response rates.
You said something that I want to pick up on, the uncertainty tax that we're seeing sort of excised over this economy. If that's the case, then what's to say once that uncertainty tax is lifted, we'll know who ostensibly gets elected, and that has passed us, and some of these other levels of uncertainty also come down. Won't that just reignite some of the confidence in the C-suite, especially at companies that do have cash, that have been waiting on investments, that have been waiting on hiring plans?
Well, that'll depend on the outcome of the elections and the policies that are being put forth. But, you know, we also may be in a period of uncertainty between November and January as well. Certain political experts have spoken to that. So it's going to depend on that outcome. Meanwhile, behind the surface, small businesses, the least confident they have been since the great financial crisis. That's not a little thing. They have their highest uncertainty and their lowest confidence. Let's remember, small businesses employ 80% of Americans. So in the background, there are these 6 to 12 months trends that are gaining some steam. The Fed has to get in front of that in order to stick the soft landing. That's why we continue to think they'll be easing policy into Q1 of next year.
So you talk about a K-shaped recovery, a K-shaped economy. You talk about this with consumers, and you also talk about this with specific sectors. And I'm just wondering, we have seen the industrial sectors in a recession for quite a while. There is some thought that maybe they're emerging from it. And now there are questions about whether some of the consumer-facing service sectors are going to see some declines after really go-go days of the post-pandemic era. Is that kind of how you see things?
I'm so happy you bring up the industrial space, manufacturing, because as much as we're talking about the labor market, one of the most interesting facts for me in the U.S. economy is that industrial production is actually smaller now than it was in 2018. The U.S. manufacturing segment is going through one of these, what I call real pockets of weakness or almost recessionary environments. Of course, we're seeing that globally as well. We're going to have to see a pickup on that if we want that side of the economy to really start reaccelerating and supporting the consumer side. The consumer is going to come down to wages and employment. And what concerns me now is that employment momentum is not going in the right direction. We need something to arrest that. Hopefully that turns out to be Fed cuts and a little bit of certainty coming out of the election.
So where's all the industrial policy money from Washington, D.C. gone?
It's not in the data. That's the real thing that we're seeing now. So month to month, we're not seeing it in ISM data. We're certainly not seeing it in the aggregate pie. And economists like to say, oh, we're not political. We don't make political statements, and I'll hold to that. But it's been very interesting to me in this particular election that we see the econ data over the past 5 to 6 years really coincident and on the same sort of themes as we see the political discourse.
Do you think that with either one of these candidates, potentially you would see a pickup in the manufacturing base in the United States? Potentially one that's talking about tariffs going around the entire wall of the U.S.?
Yeah, it'll depend on what the composition of the outlook looks like. But meanwhile, the U.S. actually has a very small share of its economy on manufacturing. Not so true for the rest of the world. Places like Germany, of course, no K-shaped recovery there. We can use hard landing for places like Germany. And just to kind of rhyme on that K-shaped theme, it's not just the U.S. economy that's in a K-shape, it's the global economy that's in a K-shape. And that upper lever, the winner, is by far the U.S. economy because it is more consumer levered, because it has less of that manufacturing exposure.
You mentioned something, and I'm not going to let this go.
Okay.
This idea that you see people's political views as economists sort of borne out by some of their expectations, their economic expectations. Are there economic expectations and projections right now that are coming out from either bent that seem overplayed to you or gaining a lot of popularity that might not be as rooted in economic theory?
Well, here's what I see. I turn on the TV, I watch Bloomberg every day, and I hear the economy is resilient, GDP's just fine, the unemployment rate is really low. But if you're a low-income consumer in the U.S., and the Federal Reserve just published data showing this, your spending is about half the growth that the high-income consumer has seen. You are not seeing the same real wage growth. So there's a disconnect between that aggregate conversation and what many individual experiences are feeling. And problematically, the top 20% of Americans fuel 40% of growth. So it's no surprise to me that we see perhaps a sentiment disconnect or a confusion over how come the experts who talk about GDP and non-farm payrolls don't reflect my everyday experience. That only takes an extra 10 minutes in the data to see that big divide between it. And I think it's something we maybe need to pay attention to in this particular cycle.
I think that speaks perfectly to the disconnect that we've seen over the last 3.5 years between some of the messaging we've seen out of the administration and what many people actually just feel on the ground. And many times they felt like they were being gaslit by the administration.
Right.
Bidenomics. And they were sitting at home thinking, I don't feel that at all.
Sitting at home, going to the grocery store, realizing they're paying a lot more and their wages haven't kept up, and those prices have not to come down. Maybe it's on the economic data, but what you're talking about, Francis, I see all the time in the polling data, especially when individuals have a chance to write in how they're feeling about certain sectors of the economy or a particular administration. They are not feeling what this good data is showing across the Bloomberg terminal screens.
Or take inflation as an example. So here we are saying, hurrah, inflation has come down, but prices are still over 20% higher than they were before COVID. Most folks in their day-to-day life are not saying, oh, this cauliflower I bought today was this amount exactly 12 months ago. They're looking at what things cost. So, it's not that the econ data is wrong. And as you started with, John, the Federal Reserve has to set policy based on the aggregate. Our stock market is driven by the aggregate. So it's not wrong to talk about that. But if you just go a layer deeply, more deeply, you'll see why there seems to be a disconnect in the data and why some data points, like, for example, small business confidence, seem completely disconnected from standard models.
This was a clinic. We've missed you, and it's good to have you back.
It's great to be back.
Thanks for being back. Francis Donald there of RBC. Your equity market on the S&P 500, a little bit softer here. We're down by 1/3 of 1%, rolling over just a little bit. If you check out the bond market board, yields grinding higher even more, taking out 424 on a 10-year. Joining us now is Troy Gajewski of FS Investments. Troy, what is this bond doing at 424?
Well, I mean, what we've had happen here, clearly, as we articulated over the last 1 to 6 months, is, when the Fed goes to cut, as we expected them to towards the end of the year, and the economy comfortably avoids recession, you're going to have a twist of the yield curve. And, historically, the spread between 10-year and Fed funds has been somewhere between 125 and 150 basis points over a full cycle. And there have been times where it's been 200 to 300 basis points or higher. So, we always question that thesis from the bond permeables of like, hey, the Fed's going to cut and the back end's going to drop. That just never made any sense to us. And if anything, we should have a steeper yield curve now because we're obviously in a higher for longer inflationary environment. We're going to issue over 20 trillion of treasuries. Treasuries have over the next 10 years, treasuries have the worst stock to flow by far of any major asset class. 20 trillion is 72% plus of the existing stock out there. And so I think anyone that jumped on the bond duration train is having regrets right now.
They might be having regrets right now, but on the flip side, we don't really see what's on the other side of this. And we have a number of people, including Matt Hornbach, saying that maybe people are overreacting or expecting an overreaction to any potential election outcome, and that ostensibly we are going to see that disinflation continue. Troy, at what point do 10-year yields become attractive to you, understanding what you just said in terms of just bonds losing some of that ballast type reputation?
Yeah, so when you look forward, I mean, we've probably bottomed for inflation for the time being. You know, we expect a modest reacceleration next year, nothing like 21 or 22, but, you know, think core in the high 2s, low 3s, somewhere in that range. And so from our perspective, you know, you take the front end of 3, the soonest we could see that happen is the summer of next year. The latest is the end of 26. That means roughly around, you know, high 4s, 5%, which is sort of where we were in October of last year when we were having the issuance panic and we had that big gap up in yields. Then you're starting to get to a point where, because of the roll down the yield curve and the additional yield, you have attractive yield, you have hedge protection, and you have roll down the yield curve. But for the time being, it's really difficult to get overly excited about duration, especially when there's so many other alternatives like private credit, for instance, or senior commercial real estate lending.
You say other alternatives, and then you go to you know, private credit and other types of alternative lending. Are you saying that stocks also have similar kinds of hair on them in terms of just a valuation issue?
Well, yeah. So when you look at equities, we're going to get growth, right? The U.S. economy, your last guest was Dynamite describing the K-shaped progression of it. Obviously, lower-end consumers have been struggling for quite some time, have been hit hard by inflation, shows up in all the polling data. Upper-end consumers in great shape, again, shows up in the polling data, you know, much more supportive of the current administration. But if you think about equities, the problem is not growth. The problem is valuation, right? Your 22 times forward earnings. Whenever you have a 20 multiple or higher, and by the way, we're very sympathetic to the fact that we should have a sustained higher multiple, just given the concentration of markets and, you know, the incredible free cash flow margins of mega cap tech. But nonetheless, you tend to have much more muted forward returns. And clearly, you know, there's been a little overextension in the short term. So in the event that yields keep going higher, we could have a mini repeat of what we saw multiple times the last 2 years, where higher yields are driving multiple compression. And then locally, Lisa, the only fundamental problem we see with valuations going into next year, not tied to long-term performance, but near-term, is, you know, nominal GDP has slowed and we expect should continue to slow. Yet markets are pricing in revenue acceleration for the S&P and also approximately a 10% margin expansion. We can get there if the market becomes narrower and narrower. I think mega cap tech, you know, Magnificent Seven minus Tesla plus Eli Lilly, Salesforce going to 40 or 45% of the S&P. But that just seems unlikely to us, given how much broader this rally has become. So, you know, those are curious data points, like 10% acceleration operating margin, re-acceleration of revenue. That's a really high hurdle to meet. So, you know, forward returns are just going to be much more muted. And, you know, volatility is not going to be as high as it was in 22, but it should be higher than it's been, you know, since October of 22 through today.
Troy, good to hear from you, sir. As always, it's good to see you. Troy Gairsky there of FS Investments. We started that conversation on the bond market. I'm so pleased that Troy went there. I think this is important. We've had a move of 40, 50 basis points on a 10-year yield since the Federal Reserve reduced interest rates by 50 basis points back on September 18th. Troy's point that lower rates are leading to higher yields, I think, is a really important one.
The idea that because the Fed is easing, or adjusting policy, they are allowing growth to be more robust over a longer term and actually allowing, theoretically, inflation to be a little bit higher over the long term, which is something that you are seeing in the break-even rates, and perhaps that's what's being reflected in yields.
424 on a 10-year. Let's give you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Frontier Airlines is exploring a renewed bid for Spirit. The Wall Street Journal reporting that the budget airlines have had recent discussions about a possible merger. People familiar said the talks, though, are at an early stage. If a deal between the two carriers is reached, it would happen likely as part of Spirit restructuring its debt and liabilities in bankruptcy, according to those people familiar. Starbucks has pulled its guidance for 2025. The coffee chain reporting its steepest quarterly sales drop in 4 years, with weakness especially evident in both the U.S. and China. Starbucks says withdrawing guidance for the current fiscal year will give new CEO Brian Niccol an opportunity to solidify a turnaround plan. Microsoft co-founder Bill Gates is throwing his support behind Vice President Kamala Harris. The New York Times reporting that Gates said privately that he recently donated about $50 million to back Harris. Gates made his donation to Future Forward, the main outside fundraising group supporting Harris. In a statement to the Times, Gates said this election is different. That's your Bloomberg Brief. John.
Danny, thank you. Thanks for this morning. Up next on the program, we'll set you up for the day ahead. You're watching Bloomberg TV.
Is the Vivian Tom clientele?
Yeah, power women, like the dragon. Dragon women. They're lawyers, they're CEOs, they're all important decision makers, women in the world.
Why do you position your products for this group of women?
When I started, designing, I always want to do something that is empower women.
When you take a look at your store, there is something for everyone. Take a look at the T-shirt, for example.
My customer growing, like 30 years already, so they become more powerful. I also want to grow my Gen Z audience too, They are like in the 20s, so it's a more affordable price for them. And then, my powerful women's daughter wearing their mom's dresses, and they feel that the power, the energy. So now they come back to the store and they buy more.
From our studios in New York and San Francisco, our expert hosts have the data and analysis about the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action, every weekday, only on Bloomberg Television. Context changes everything. Fixed income fix. Watch Bloomberg Real Yield every Friday right here on Bloomberg. Context changes everything.
The open about 38 minutes away. Equity futures down by 1/3% on the S&P 500. Check this out in the bond market. Yields up again, up by 3 basis points. It's just persistent. Keeps going. 424 on a US 10-year. Let's get to the trading diary, the calendar. Stacking up as follows. The Fed beige book at 2 p.m. Eastern Time. Lisa logged into the Bloomberg,
well, 100%.
waiting for it to drop. I know.
Yeah, I actually will be on a train to Washington, D.C.
Tesla reporting earnings after the closing bell. Tomorrow, another round of jobless claims plus S&P global PMIs. Plus, we'll also get earnings from UPS, Southwest, and American Airlines on Friday. Durable goods and UMich consumer sentiment. Over in Sao Paulo, Brazil, the Bloomberg New Economy Forum continues today. Joining us now is Bloomberg's Jemana Besechi. Jemana, congratulations for getting this one, because this is the one we all wanted to be at. Just a phenomenal conference. Walk us through what's coming up.
Hi, guys. Good to see you. A bit out of context. That's right. Well, it's all kicking off in Brazil. There are plenty of events happening here. B20 kicks off tomorrow. There's G20 in a month's time. And then next year, of course, Rio de Janeiro is hosting COP. But for now, we're here at the Bloomberg New Economy Forum. The title of today's forum is Bracing for a New Reality. And of course, the world has to adapt to so many different pressures now, from climate change to geopolitical risk, war, conflict, in addition to advances in technology. But this is really an opportunity to bring together some of the leading voices, the policymakers, industry leaders, to discuss some of these challenges. And top of mind, of course, is the growth outlook. Yesterday, you may have noticed that out of all of the advanced economies and developing economies in the world, Brazil was one of the few that actually got upgraded with their growth profile for next year, an increase of 0.9%. But does that change in a world of protectionism, potential new tariffs coming out of the US, a lot of talk about the upcoming presidential elections? You also will recall that President Trump was very close to the former Brazilian President Bolsonaro, who is the current rival of President Lula. So that is one factor to take into consideration. How will relations change should there be a change in the White House administration? Also going to be talking about the digital disruption that's taking place. I have a panel on this later with the Google president of Brazil. And again, here, you may also remember that the Brazilian regulator had a bit of a run-in recently with Elon Musk over this social media platform, over concerns that it was being used to spread this information. So again, one of the questions we're going to be posing is, how do you get that balance right between regulation and innovation? And then last but not least, of course, we're going to be talking about the push towards low carbon. We are in Brazil, home to the Amazon. It is considered to be the lungs of the earth. But at the same time, and this is a statistic that I didn't know before I came here, 93% of the electricity generated in Brazil is generated from renewable sources of energy. So how do you take that template and how do you make it at scale? And how do you mobilize the sufficient amount of capital into these types of technologies so that we can move towards a more cleaner and greener energy transition in the future? Those are going to be some of the questions posed here.
Giovanna, thank you. Thank you very much. I'm not jealous at all. Oh, yeah. I know where I'd rather be this morning.
Honestly.
I love you guys.
Okay,
but
yeah,
I love that city a little bit more.
Yeah, not just the city, but also that particular hotel.
Yeah.
Very beautiful.
It's one of the best in the world.
Pretty amazing.
It's just
I've never been. I've never had the opportunity.
phenomenal.
I wasn't invited.
This is where Bramo's going. Coming up tomorrow on Friday. Here's Lisa's lineup. In Washington for the IMF and World Bank meetings, speaking with the South Africa Reserve Bank Governor, Lesetja Kganyago, the Bundesbank President, Joachim Nagel, John Lifsky, the former IMF First Deputy Managing Director, and the City Chairman, John Dugan. Have you got a favourite? What are you looking forward to?
Oof, that's like picking a favorite child.
I'm
not saying
they're
their
not
child. No. But honestly, I think it's going to be really interesting to get both of you from policymakers and central bankers, as well as some of the big executives from banking industry. So we're not only going to have John Dugan, we're also actually going to have an interview with Christian Saving. We're also going to have an interview with Sergio Armati and Botín, a number of different executives, particularly in the European banking sector. Curious to see how the ties go together at a time where there are a lot of economic questions on both sides.
So no favourites, but the bank CEOs, apparently. Coming up tomorrow, Dan Ives of Wedbush, Deputy National Security Advisor Dalip Singh. You actually are, literally. Former House Speaker Kevin McCarthy and Biggie Chadha at Deutsche Bank. Stacked lineup tomorrow. Tune in from New York City. Thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
About future of such, no. Myself, 5 years ago, if you told me that, I will say no. I will never.
A few minutes ago, we asked the live audience on X to submit a few requests for what they would like us to try out here. So I will take a couple of prompts. Okay. Bot Gaskar wants to know if GPT-4o is capable of real-time translation. Mark, you want to try this one?
Sure, yeah, let's do it.
All right.
Yeah.
I speak Italian, so we can just do English-Italian.
Let's try to do English-Italian. Sure, let's do it. Hey, ChatGPT, how are you?
I'm doing fantastic. Thanks for asking. How about you? How's your day going?
I'm doing great. So I would like you to function as a translator. I have a friend here who only speaks Italian, and I only speak English. And every time you hear English, I want you to translate it to Italian. And if you hear Italian, I want you to translate it back to English. Is that good?
Perfetto.
Mark, io mi chiedo se le balene potessero parlare, cosa ci direbbero?
Mike, she wonders if whales could talk, what would they tell us?
They might ask, how do we solve linear equations?
potrebbero chiederci come risolviamo le equazioni lineari.
Sicuramente sì.
Certainly yes.
Great. Looks like it works.
All right. So the next one is from Burrito John 78, who asks, can you tell what you're feeling just by looking at your face? Barrett, you want to give this one a try?
Absolutely. Let's try it out. Hey, ChatGPT.
Hey there. What's up? How can I brighten your day today?
Okay, yeah, so I'm going to show you a selfie of what I look like, and then I'd like you to try to see what emotions I'm feeling based on how I'm looking.
Sounds like a fun challenge. Go ahead and show me that selfie, and I'll put my emotional detective hat on.
Okay, so here's me. So what kind of emotions do you think I'm feeling?
It seems like I'm looking at a picture of a wooden surface.
Oh, you know what? That was the thing I sent you before. Don't worry, I'm not actually a table. Okay, so take another look.
That makes more sense. There we go. It looks like you're feeling pretty happy and cheerful, with a big smile and maybe even a touch of excitement. Whatever's going on, it seems like you're in a great mood. Care to share the source of those good vibes?
Yeah, no, the reason I'm in a really good mood is because we were doing a presentation showcasing how useful and amazing you are.
Oh, stop it. You're making me blush.
Amazing. Well, that's it for today on live demos. As you can see, this just feels so magical, and that's wonderful. But we also want to remove some of the mysticism from the technology and bring it to you so you can try it for yourself. So over the next few weeks, we'll be rolling out these capabilities to everyone. Today has been very much focused on the free users and the new modalities and new products, but we also care a lot about the next frontier. So soon we'll be updating you on our progress towards the next big thing. And before we wrap up, I just want to thank the incredible OpenAI team, and also thanks to Jensen and the NVIDIA team for bringing us the most advanced GPUs to make this demo possible today. And thank you all very, very much for being a part of this today.
Well, Starbucks down now almost 4%, 3.8%. They suspended guidance for 2025. The new CEO, Brian Niccol, is grappling with declining sales in the U.S. and China. Tough way to start out, Matt.
Yeah, absolutely. I mean, we've had some up and down earnings stories this morning. You've got a beat and a raise at Coca-Cola, AT&T disappointing. But really, the big earnings stories came out after the bell last night. You mentioned McDonald's, you mentioned Starbucks, and those are dragging on the index today.
Big time. McDonald's down mightily this morning. We knew that things were turbulent over at Starbucks. McDonald's, of course, coming out of nowhere with this E. coli outbreak. Pretty shocking to see shares down almost 8%. Pre-market, really taking the market by surprise.
And it's interesting, the bulk of the earnings are next week, of course, but then we do still have Tesla to look forward to within a number of hours. And you have to wonder, with the sour mood you've had in the market this week, what's going to start to turn the page? Because a beat, in many cases, it doesn't seem like enough for investors to hang their hat on with valuations still this high.
Yeah, we got, 7 hours to go until Tesla earnings after the bell. Joining us to unpack all of this earnings news, a lot of it consumer news. Obviously, Coca-Cola, McDonald's, Starbucks. Michael Halen joins us from Bloomberg Intelligence. And Michael, it's really McDonald's that stands out the most to me. 1 dead and 50 sick with E. coli after eating, what is it, quarter pounders with a sliver of onion?
Yeah, it was, usually you hear it in lettuce or spinach, but yeah, it's usually a raw product, and it sounds like it came from the onion. Yeah, tragic, man. And this is one of the worst things that can happen to a restaurant chain, right? You want to provide your consumers, a tasteful yet safe product. Really terrible news.
Yeah, absolutely. And of course, I heard you speaking on radio with Tom Keene and Paul Sweeney talking about if you grill the onions, of course, that will help cut down the risk. But it's interesting that we have some blueprints for how McDonald's can manage out of this. You think of Chipotle, for example, obviously dealing with their own E. coli outbreak. Wendy's has had some issues in the past as well. I mean, what is the roadmap here for McDonald's?
Yeah, I think the roadmap is potentially changing the operations. I mentioned potentially grilling onions would kill the bacteria, the pathogens. Also, they're going to have to prove to the consumers and to investors that they're doing what they need to do in terms of food safety. Right? I think they've responded very quick with the incident yesterday. They've acted swiftly to stop sales of quarter pounders in the area and quickly identified the supplier. Operations has always been McDonald's strong point, right? But they're going to have to show some penance and make people comfortable enough to eat in the restaurants again.
While we have you, I want to switch gears, talk about Starbucks for a second here, because it's another prove me story going on. Of course, investors love Brian Niccol, but they don't seem to love the idea of suspended guidance. What did you make of their move to kind of buy him some time there?
Yeah, I think any smart CEO is going to do that, right? They're going to suspend guidance so they have more time to get their initiatives in place, right? You can't turn around the aircraft carrier on a dime, right? You're not going to turn Starbucks around in 3 months, right? So the poor report was no shock to us. I mean, results have been abysmal for the last 2 quarters. We've been writing for a year. That trends were looking pretty bad here. So no, to me, Brian Niccol is just like it helps him next year because it's just another easy lap to comp that he's going to get to comp over. So I think this is old news to most investors. I think going forward, it's going to be about what Brian Niccol can do and about some of these management changes he made at the top of China and now with a chief brand officer and moving forward and creating a culture of transparency, trust, accountability, and hard work.
Michael, it's a great point that eventually what we're seeing now with Starbucks will turn into easy comps, but certainly feels like a long road to get there. That is Michael Halen from Bloomberg Intelligence. Meanwhile, let's broaden out here, take a look at futures, of course. We are less than 30 minutes until the bell, and as you can see, we're staring down at a down day. Currently, the S&P 500, the NASDAQ 100, the small caps, they're all lower across the board. And that is our jumping off point to discuss with Bernstein Private Wealth Chief Investment Officer Alex Chaloff sitting to my left. Great to see you in person.
Thank you for having me.
Let's start with earnings because we've been talking about the earnings reaction, and actually it's been pretty good. The S&P 500 members that have managed to beat earnings are being rewarded by 1.7% on average in the stock market the day after reporting results. At least according to Bloomberg Intelligence, that is the strongest rate in records going back to 2019. But then you take a look at a setup like today, it doesn't necessarily feel like it.
I don't think today is so much about the earnings, even though we're in the middle of earnings season right now. We've got this week with 100 plus, next week with 100 plus, and the third week with 100 plus companies reporting. We're in it. So every day there's going to be some focus on earnings, but the market right now feels more about uncertainty around the election. Where do we go from here? What's fiscal policy? Look at what the 10-year is doing. 10-year doesn't have anything to do with earnings today.
What are you watching with regards to the election? I was just showing a chart that betting odds are rising. We've talked about the potential flaws with relying on betting odds, but betting odds are rising on the possibility of Trump getting into the Oval Office. And with that, we see the 10-year yield rising. We see the dollar index rising. What have you got your eye on in regards to the election?
Well, it's too close to call. Normally at election time, I'm doing my best just to dodge and play down the middle. Thankfully, I don't have to do much dodging because it really is neck and neck. I think the bond market is voting Trump right now. They're expressing a view that fiscal policy will expand, and that's why rates are moving.
Is that what's going on, though? Because that question is being asked across all media, really, financial media. Is this a Trump trade in the bond market, or is this just a reaction to the economic data that we're getting?
I think it's more about a growth scare than an inflation scare. If you think about what markets have been concerned about over the last couple of years, it's been inflation. Now we've put that behind us, and now the concern has moved to growth. Are we growing too quickly? And rates are clearly moving to respond to that. But look, no matter who wins in a couple of weeks, and when we finally learn who wins in a couple of weeks after that, there's expansion in fiscal policy. Both parties have expressed that. So either way, the 10-year is doing what it should do right now.
Alex, what are you watching on election night? You have really the country on a knife's edge when you think about where people are going here. You see the Trump trade in the bond market, as you said. Are you watching the dollar? Are you watching bonds? Are you watching equities the next day? What moves?
I think Well, I'll be watching Bloomberg on election night, of course.
Thank you.
And listening to it on radio when I go to the kitchen.
As you should.
Thank you. But I think we're going to watch everything. I mean, there's so much vol right now in the market, maybe not expressed in the VIX per se, but the 10-year, you're seeing currency, the dollar's having some interesting moves. And you're seeing some sectors move around, over the last couple of weeks. Quality has really carried it out. People are moving into the low vol space. They want safety. They want security. They're trading for dividend yield. Their hedge funds are de-risking. You talk to the prime brokers and the desks. Everyone's taking down the risk and just saying, not this time. I don't want to be exposed in the wrong way.
It's incredible. 424 on the 10-year this morning. And, Matt, I lose my mind to you at the desk every time we see movements like that. I do. I shake him physically. And so I actually do. And so, Alex, you look at that and you want to ask what the read-through is to the stock market. If rates stay elevated, particularly on the long end, do equity investors get comfortable with that kind of revised discount rate?
I think that we've been living in a 4-handle 10-year for a while, alongside a market that's been premium valued. I'll be generous. And so...
Not too rich?
Not too rich, not too rich. With the earnings growth that we're having, even with a modest slowdown this quarter, earnings coming into the year, the expectation in the S&P was 11.5-ish. Right now, the full year is 9.5%. Next year will be 15%. 26, for what it's worth, is another big number. So the earnings support the multiple where we stand today. But look, it's tricky. It's hard to justify when you plot the 10-year next to the multiple on the S&P. Today's market doesn't make a lot of sense. You got to fall back to earnings. It's all about the growth rate of earnings. And earnings are growing while inflation is dropping.
We are going to talk to David Kostin in just a moment. He's got a pretty bold call that we're only going to see a 3% annualized return over the next 10 years. That's only happened, mind you, when we've had the Great Depression or the oil shock or the financial crisis.
Yes.
Do you see that coming as well?
We've been saying for the last couple of years that returns are going to come down in pure long-only equities, especially in the S&P 500. Our forecasts are very similar to what your guest in an hour will talk about. We're probably closer to 5 than to 3, but it's the same neighborhood. Our expectation is, it's going to be a foot race between investment-grade credit and equities for the next few years. And that's, everyone's panicking. I won't say panicking. Everyone's nervous around the 10-year is so high. Oh, my gosh. You know what that
Janali is panicking.
I know. There's some
in
the morning. She's like,
I have
oh,
no
my God.
emotions around it.
Janali, I'm going to tell you to relax. Everyone take a breath. Because if we hang around these levels for a while, we're going to clip this coupon for the next 10 years.
Yeah.
And so I think that, and if you're at 5 and I can get credit to 5, with some research, I can push 5.5. This is fun. So our bond guys have been in a winter in 2022, and now they're very excited about where we go from here. Our equity guys, they're still focused. They still think they can grind out a little bit of return above and beyond what we talked about, especially excited about what's going on outside the U.S. We focus on the S&P, but looking outside the U.S., there's real cheapness. There is earnings growth. I'm not going to say anything about what's going on in China because that may be short-lived. But there are really some things to get excited about overseas.
Alex, thank you so much for joining us here in studio. Of course, that is Bernstein Private Wealth Chief Investment Officer Alex Chaloff. And coming up, U.S. allies reminding the world of the importance of the upcoming presidential election. We're going to be joined by German Finance Minister Christian Lindner. Joining us next. This is Bloomberg.
Is on. Everything you need to get Hit the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take-Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Our principles, our policies in support of the Palestinian people will never change. Our policy in having a two-state solution will never change, and nothing will compromise it. And as long as we are, having the capability to be helpful, we will do it. We did that between Afghanistan, between Taliban and the US. We did that between different parties in Lebanon and Sudan and others. And that's basically the core of our foreign policy. It's been built based on mediation, on trying to help in resolving conflicts between the party. There are countries or people might not like it, but we don't ask everyone to like it, just to understand it.
There is this real momentum from Wall Street.
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
All right, we have less than 2 weeks to go until heading to the polls here in the United States, but our allies are reminding us that the outcome is consequential to the whole world. German Finance Minister Christian Lindner, in a speech at the University Club of New York yesterday, called the vote a decision for the League of Liberal Democracies who share our common values. Lindner, who is also the head of Germany's pro-business FDP political party, joins us now on set here at 731 Lex. Great to have you with us. Thank you so much, Mr. Minister. My first question, do you think former President Donald Trump shares those common values?
The Republican Party shares those values, and it's in the best interest of the U.S. To remember that there's one difference between the U.S. and Russia and China and others. The United States, they have allies in the world like Germany, France, and others, and it's in the best interest of the U.S. Doesn't matter who enters the White House, to remember this. Together, we are stronger, and together we are able to maintain the rule-based international order and the multilateralism we all benefit from.
We all work together, but it seems to Mr. Trump and to others that America foots the bill, usually, right? Germany, for the first time, has met its pledged 2% of GDP target for spending, and that is only because of a special 100 billion euro package. Do you need to raise your defense spending more going forward?
We will. As you have pointed out, Trump and his predecessors, they were right. There hadn't been a fair burden sharing among NATO members, but this is the past. Germany reaches the 2% objective of NATO for defense, and we will continue to do so. At the
in the
moment,
next year as well, because it
yes.
seems that as this package is spent, you'll be spending far less.
I can assure you, we not only know our responsibilities, we can see the geopolitical reality. There is a new normal. We have to deal with Russia, which has not only attacked Ukraine, but tries to harm the international rule-based order, and we cannot allow this. So this is why we have a change in our priorities, in our policies. We have started with this extra budget of 100 billion euros for defense, but this won't stop. We will continue out of the regular budget from 2028.
I do want to talk about how tariffs would factor into all of this, because of course Donald Trump has pledged 60% tariffs on China, but 20% on everyone else. And you think about the German economy, of course, this month the government cut your GDP forecast for next year. You expect a contraction of about 0.2% instead of growth. That's before tariffs. If tariffs were to pass, if we were to see those 20% levels, how do you even model for that?
We have to find a level playing field and a fair trade agreement among European Union and the US, whoever is in the White House. It's in the best interest to cooperate. I can understand that the US realize that the People's Republic of China is a strategic rival. And I'm not convinced by the trade policies of the People's Republic of China. But we should not forget that we benefit, US and European Union, from our trade relationship. It's not only security, it's economy as well. And so, first part of my answer is diplomacy. We have to talk to each other, whether there are concerns and how we can overcome them. And the second part of my answer is, well, the European Union as a whole and Germany in particular, we have to restore our competitiveness. Germany has been losing competitiveness for a decade now, from year to year. And now we have to focus on our strengths. We have intellectual property, a qualified workforce, a well-capitalized economy, including our SMEs, the hidden champions. But we have structural deficits on the supply side of our economy, and now we are introducing a growth initiative with over 100 measures, from mobilizing labor market to tax incentives for investment and research.
To follow on Katie's question here, though, if Trump were to win the White House, some of these tariffs are very significant. Could you lay out what is at stake for your economy if you do see those go into fruition?
Well, every kind of trade conflict harms both sides. Right. There won't be success for anyone out of a trade controversy between the US and the European Union. So this is why I cannot only answer your question with regard to European Union or Germany. It is not in the interest of the US to follow protectionism. We have to deal together with People's Republic of China. The People's Republic of China is a possible risk for the League of Liberal Democracies and Free Traders all together. And this is why we should stick together as allies.
I don't know that there are any free traders left in this country. I mean, it's not only Trump putting in these protectionist policies, right? Biden passed the Inflation Reduction Act, which subsidized our auto industry here to the detriment, I would say, of Germany. Do you have plans to subsidize EV sales in your country? You have a difficult situation selling EVs, and you're looking at possibly closing down a Volkswagen plant.
Well, first of all, I have my doubts that the fiscal policy of the US can be continued in the foreseeable future. And on the other side, there is a huge amount of taxpayers' money on the table in the European Union. So given the size of our economies, we are subsidizing in Europe already a lot. So compared to the IRA, I think we have no deficit. The competitive disadvantage of the European Union is capital markets union. We have a lack of private sector capital. We have those pay-as-you-go pension systems instead of pension funds. And so this is the area I am focusing on. And the situation of the German car manufacturers, I can assure you, they are producing the best cars in the world. Doesn't matter whether electrified or combustion engine, and I'm convinced they will be successful even after a phase of transition.
Yeah.
I do not intend to introduce further subsidies. We have to focus on the charging infrastructure. Okay, there are still some deficits to convince people of buying those cars. But the framework conditions for our car manufacturers in Europe as a whole have to be reconsidered. To be very frank, I think the end of the combustion engine in 2035 is not only too early, I think we do not need that date. We should be open for all technologies, and even the combustion engine is possible to be used climate neutral with synthetic fuels.
Yeah, that'll be interesting to see how, especially Porsche, moves forward with that. I want to ask about, you said that you doubt the fiscal situation in this country can go on, and this is something we talk about a lot on this program. What do you think stops the spending orgy that both parties have planned? Is it voters? Is it the bond market? What holds us back?
Well, I'm a supporter of a market-driven development, and so there could be a situation in which the US politics will reconsider whether it's in the best interest of this country to spend so much taxpayers' money for servicing old debt. But I'm not here to give others advice. I can only claim for Germany, we won't follow that path. So we try to modernize our framework conditions. We are introducing structural reforms, but we will keep the stability of our public budget. We will be reducing deficits and debt to GDP ratio.
We thank you so very much for joining us here in studio on your trip to New York. That is, of course, German Finance Minister Christian Lindner. And coming up less than 4 minutes to the opening bell, we're going to discuss where markets are headed. We have Goldman's David Kostin, of course, out earlier this week with a big call. We're going to talk about it. This is Bloomberg.
How do we reach down to the 18 to 35-year-old market? How do we bring these kids, these influencers, this new generation of people interested in the game of golf? There's 738 million people in the world who are interested in the game of golf. Don't play the game of golf, but interested. There's about 60 million golfers. So we have another 670-odd million people we can go figure out how to get them interested, not just in live, but in the game of golf. And so we sit down and you talk about this internally with your production team, you talk about with your marketing people. When you look at our audience base today, that we have like about just around 50% of our ticket sales are 45 years and old and younger. Following the PGA Tour, it's the oldest aging demographic in sport. It's 67 and a half. So in a matter of year and a half, basically, we've pulled that 67.5 down to 45 because of our product, because of the entertainment side. There are places around the world where 32% of our ticket sales are women. So they're coming to an event that they feel inclusive with, right? So all of a sudden, we're seeing these data points coming out going, my gosh, we're owning this space.
Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything.
Bringing you up-to-the-minute financial news whenever and wherever it happens. I'm Michael McKee at the Federal Reserve, and this is Bloomberg.
We are moments away from the start of trading, and we could be looking at the third down day in a row. Yesterday, we came back up into the green a couple of times near the closing bell, but sunk down to the red for the final trade, and that means we had back-to-back losses. The first time that's happened in 6 weeks, over 30 sessions, and now we could have a triple. Take a look at the opening bell. I think it's interesting. It's not there yet, but do we have it? Are we going to have it? Because I think it's the Liberty. I think that the WNBA champions are ringing the opening bell in New York, but I can't see anything there. It's less interesting at the NASDAQ. There's a biotech company called Upstream Bio, but we haven't mentioned on this program yet that the women of New York won the national championship in basketball, which is pretty cool, Katie. It doesn't, however, save us from a down day on the major averages. What do you see?
That was a very artful segue, and you're absolutely right. You take a look at the screen behind me. There is just red across the board right now, starting with the S&P 500, down about 0.3%, and then it gets worse from there because you have the NASDAQ 100, 0.4%, and then your small caps down about 0.5%. We are in the thick of earnings season, but we were having this conversation with Alex Shaloff. This probably isn't earnings related right now, but watch the NASDAQ 100 once, of course, Tesla reports after the bell. Meanwhile, let's take a look under the hood and get back to those earnings because Boeing's new CEO says that the plane maker needs time before it can consider developing a new aircraft. Of course, it reported a third quarter loss per share that was steeper than expected. It missed on revenue, and oh boy, you take a look at that cash burn. You add it all together, shares down about 1.5%, which is pretty contained, Shonali, but this is a stock that's down nearly 40% year to date.
A little less contained here. We are looking at shares of McDonald's down 7% or more as the market opens. This is after that E. coli outbreak was reported linked to its quarter pounders that has sickened dozens of people in the United States, Matt.
Yeah, definitely something, well, I'm going to try and avoid. I also haven't been to Starbucks in a while, and that company pulled guidance for 2025 after sales plunged for a third consecutive quarter. Challenges, I guess you could say challenges mount for CEO, the new CEO, Brian Niccol. The challenges were already there. That's why they brought him in, and this actually frees him up to do a little bit more in terms of a turnaround. Shonali?
And this week, you might remember, Goldman Sachs came out with a note saying that the streak of blockbuster gains for the S&P 500, it might be over. And they say that we'll only see around annual gains around 3% over the next decade, compared to the average 13% over the past decade. And we are joined now by Goldman Sachs Chief U.S. Equity Strategist David Kostin, who led that call. He joins us now. When you think about this call, very controversial, David. And so I am very curious about kind of what the caveat is here. Is there kind of any upside that could be squeezed out of the equity market that is outside of this base case?
So let's talk about the base case for the next year, and then we'll look at the base case for the following 9 years for full year, decade of performance. So the next year, we're looking at the S&P 500 rising around 8%, 9% total return to an index level of around 6,300. And the thought process behind that is the U.S. economy is growing, inflation's coming down, the Fed is cutting rates, earnings are growing 11% in calendar 2025 and another 7% in calendar 2026. And that sets up with a valuation today of around 22 times earnings, slight compression in the multiple. That is the building blocks to a return in the next 12 months of roughly 9%. So what we focused on in this report was what's the probable total return that an investor should anticipate for the cap-weighted S&P 500 index. And the conclusion was a range of somewhere between -1% and +7%. Midpoint of that is around 3%. What is the driving force behind that thought process and that analytics? Well, there are two issues. The first is valuation. We know when the market trades at a high multiple, a high valuation, that the next 10 years is typically low relative to an environment where, say, the multiple was low at the beginning. You tend to get a pretty strong return in the subsequent decade. So we're sitting here with a cyclically adjusted PE multiple that's different from a forward one-year multiple. Based on the cyclical adjusted earnings for the last decade of 38 times. That's the 97th percentile versus, say, the last 100 years. So it's a very, very expensive starting point. And what's new about the analysis is that we also include a variable for concentration. We're in one of the highest concentration markets in 100 years. Top 10 stocks, for example, comprise around 36% of the index. That's an extremely narrow concentration. And historically, when you have a high concentration market, you have a relatively muted return in the subsequent 10 years. Now, valuation and concentration are two different variables. They're not correlated. And so there's two different influences as to why we get a lower, relatively modest return. Yep. Now, what are the implications for a portfolio manager? Matt, the way you want to think about this is equal weighted. The equal weighted return is likely to be probably 500 basis points greater. So instead of 3% for an aggregate index, something like 8% for the typical equal weighted index. And so that's the conclusion of the report.
Well, but the concentration is in, I think, very many global champions, right? I mean, you have companies that dominate their spaces globally. Plus, we've got a few that are likely to come on board soon. SpaceX, for example, OpenAI may go public in the next decade. And if I look, David, over the last decade, I actually stole this chart from DataTrek, as I've pointed out before, but the only time that we've had 3% returns has been when we've had catastrophic events, the Great Depression, the oil shock, the financial crisis. Do you expect something like that to come again over the next decade?
No, what we're anticipating is a broadening of the market, the relative performance of the typical stock versus an aggregate index. What we're focusing on is a strategy for how to perform well. When we deal with some of our largest institutional clients, sovereign wealth funds, pension funds, endowments, insurance companies, family offices, when they think about a 10-year horizon, they think about asset allocation, where are the risks, and the idea of a very concentrated market is what tends to be a risk that gets introduced, and that is the emphasis of this report, and that's the thought process, that's the analytics behind it in the model that we build. We look at rates, we look at the economic environment, we look at the profitability and the ROE of companies, and so all of these variables at the index level relative to the typical stock, that's how we get to a conclusion, that it's a better strategy, a better return strategy from our perspective with a equal weighted strategy.
Well, David, I want to talk about the cross-asset nature of this call, too, because you say that it's likely that bonds are going to outperform in this environment. But reading through this call, I mean, if you're not calling for a recession here, I assume the Fed doesn't cut rates back to zero. Wouldn't this be a call for cash? Aren't cash yields going to stay relatively high and you don't have any credit or duration risk there?
Well, I mean, there's other strategies. You could look at private credit. You could look at private equity as a potential way of diversifying a portfolio. Relative to right now, the idea of treasuries, 10-year treasuries yielding 4.2%. So if you were to start today and look out with our centerpiece of or the central case of our forecast, something like 3%. But if you look at the distribution, look, the idea of being at the high end, there are a lot of reasons why you could be at the higher end of our range, closer to 7%. Matt identified a couple of those. You typically get around 3.5% of the constituents in the S&P 500 turnover every year. So we look out for a decade, you're probably looking at a third of the index. There's going to be new stocks that don't exist today in the index. So there's certainly a lot of variables that could happen. The economy could be growing more rapidly, more slowly than a baseline forecast. those are their issues. AI, in terms of artificial intelligence, could raise productivity. I mean, lots of reasons why it could be better than our base case scenario, which is why we have a range to the upside and the downside.
You know, one thing that struck me in this note as well is a 1/3 chance that you have the S&P 500 lagging inflation through 2034. What's the role of inflation here, and what is the risk that it could be higher? What if the neutral rate is higher? What kind of impact would that have on equity market returns?
Well, so you think about inflation right now, the TIPS break-evens are around 2.2%, for example. And so based on a scenario where you have a return that could be -1% annualized versus +7%, kind of there's a distribution around that, relatively normal type distribution. The part tail of the distribution would give you a prospect of a return that's less than inflation. That's not the base case, but it certainly is a scenario. You know, when we deal with portfolio managers, they want to think about what are the risks that are introduced into their portfolio. And the argument behind a broadening of the market is an important construct. So one of the arguments on why mid-cap stocks are likely to do better than the rest of the market in the coming year. They have the best torque to the idea of the Fed cutting rates. They got 25% of their balance sheet is floating rate. So you have the Fed cut rates, they have less interest expense, they have higher earnings, positive earnings revisions, drives equity prices. And so those are tactical issues, opportunities in the market. So we think about tactics, we think about strategy longer term, and that's the purpose of writing the report in response to questions from clients about how should we think about the prospective 10-year forward returns in the equities.
Right. David, we don't have a lot of time left. I know I have a question. I know that Matt has a question as well. So let me ask you this quickly. I want to get existential about the business that you're in, because you think back to January, and actually Wall Street strategists on average were expecting the S&P 500 to rise about 2% this year. It's up 23%. And I'll flip the question to you. Is it getting harder to model, to forecast where the index is going to go?
Well, it is challenging because a third of the index is comprised right now of about 10 stocks. That's not just tech stocks. You have some healthcare stocks, Eli Lilly. You've got Berkshire Hathaway's in the top 10 companies, for example. Depends on the day we're looking at. It could be Visa, Broadcom, different constituents, along with the big tech companies that we're all familiar with. And so it's challenging to look at the market that's that component, and you can look at the rest of the balance of the market. So you think about those big stocks. They trade at 31 times earnings. That's a 2.7% or so earnings yield. It's a negative risk premium versus 10-year treasuries. So that's a concern about valuation. And then you have the concentration item that I overlaid. The rest of the market has a positive risk premium versus bonds. And so that's one of the attractive components of why there's a broadening of the market and why we anticipate that to persist.
David, I have an election night question for you. When you get home, put on your slippers, grab a scotch and your pipe or whatever, and you settle down in that lazy boy, right? Click on Bloomberg TV. What are the indexes or the assets, or what are you going to be watching on election night as we hopefully get a clearer picture of who's going to occupy the White House in the next 4 years?
Well, the election is obviously quite close in terms of the polls and things like that. So I think there's a couple things that we look at. First, is there a split Congress versus the presidency? That would suggest there's certain executive actions that can be taken, whether that's respect to tariffs, whether it's respect to certain regulation aspects that the presidency, he or she, could implement.